Hi everyone. Today, let's talk about the news. So I've decided to do this segment every Monday, and I'm going to focus on what I think is currently driving the markets. So we'll take a look at the most recent week in terms of price action, and then we'll take a look at what I think is going to drive the market, at least for the next week. So this week, we had a little bit of a resurgence of the cough situation, and this brings a little bit more uncertainty into the markets. We were fairly confident that the cough situation had subsided, but now cases are on the rise. Second, Biden's lead in the polls could be behind some of the market drop. Says here, the former vice president has pledged to end Donald Trump's tax cuts, which have boosted corporate profits. It also says, looking at the data, anytime the White House has flipped from Republican to Democrat, the S&P 500 has underperformed for the following 3 months, since 1951. And last up, monthly job reports are due on Thursday. Says here, Wall Street and corporations and investors use this jobs report to gauge the overall health of the economy. Also, health of the economy tends to drive the value of the dollar. As always, there will be some jelly at the end, which is something I enjoyed outside of the markets. If you have big dreams like buying the Lana, or if you're just getting started on your own financial journey, definitely like and subscribe. It has not one, but 2 full-size dining spaces. It has a very nice sitting area, even if it's all one color. Definitely has an awesome staircase though. It includes a spa and a very nice master suite. To keep your dreams at the front of your mind, like and subscribe. Welcome to the Portfolio Bulletin. Let's get started. Let's take a quick look at the SPY technicals. This is the 4-hour chart, and currently we are sitting right at $300, which is currently being supported by the 200 moving average. And it did, in fact, close just below that 200 moving average on the 4-hour. Moving in here to the 1 hour for you day traders out there, it looks like a bearish trend is starting to begin. The real question is, are we going to break those lows from the 15th of June? And if we break those lows, then I think we're going to see some more downward price action. Going in one more time to the 30-minute, we see pretty much the same thing that we saw on the 1 hour, a more convincing downward trend. All right, let's get started with the first article. It seems like there is some pandemic uncertainties returning to the market. We were pretty optimistic for a little while, and now we are downtrending. It says here that optimism about the V-shaped recovery, backed by monetary and fiscal policies and states reopening, has been challenged by the Rona, which has surged to a record 40,000 cases on Thursday, which caused all of the major indices to drop from between 1.9 to 3.3%. It goes on to use American Airlines as an example of one of the beneficiaries of the federal spending. They were able to sell $1 billion of common stock, as well as $1 billion of convertible securities and $2.5 billion of convertible notes. All of these actions will let American Airlines weather the storm a little bit easier. On top of all of that, American is also seeking $4.75 billion from the CARES Act. All of this is really to say that companies like American Airlines understand the fact that this Rona situation is not complete. We are probably somewhere around halfway through, and hopefully by the end of the year, we're going to see that this thing has pretty much wrapped up. Companies are still bracing themselves, and I don't expect this situation to be over really before the end of the year. It then goes on to talk about some of the things that have been propping up the market, like the extra $600 per week in unemployment benefits. Then it goes on to talk about how New York City is looking at laying off 22,000 employees. And this is mostly because their tax revenues have been cut pretty extensively due to the lockdowns. Next, it talks about a potential for another federal stimulus of $1.5 trillion coming to the floor after the 4th of July recess. We'll see what's in that. The current bill that the House passed is not going to pass in the Senate, so maybe they've reworked it and come up with something that can actually be passed. Next is the non-farm payrolls. It's expected to show a 1.6 million increase in private payrolls, as well as a 100,000 drop in government payrolls. The final point here is that there is an election in November. It states that Republicans and Donald Trump would be favorable for the stock market, while Joe Biden, the presumptive Democratic challenger, favors raising taxes on corporations. which leads right into our next article. It says here that many analysts fear that a Biden presidency will be bad for the stock market. He has already pledged to roll back President Donald Trump's tax cuts, which boosted corporate profits. And this chart shows that Donald Trump is trailing by around 14%. Jim Cramer on CNBC mentioned that this is a Biden move to him. He said, "When I see across the board selling today, that's Biden." He sounds like another president that is not going to be favorable to capital. And if that's the case, then I want to have a little cash. Another survey taken by RBC Capital stated that the re-election of Donald Trump would be bullish or very bullish for stocks, and 60% stated that Joe Biden would be bearish or very bearish for equities, which was a significant jump from the 24% of respondents who held that view in December. It then goes on to say that former vice president has already stated that he will raise the corporate tax rate back to 28%. And based on that, Goldman Sachs says that the current earnings per share forecast for the S&P 500 would drop from $170 to $150. The rest of this article goes on to talk about mostly opinion about how Biden would not be very good for the economy. One thing not mentioned in this article is the fact that the Democratic Party is in favor of some pretty dramatic reforms to the healthcare system, which would be pretty detrimental to current health insurance companies, as well as very expensive, which would potentially entail some more tax increases. This chart shows some historical data from when the party in the White House switched in correlation with the stock market. The last market mover this week is non-farm payrolls. These come out on the first Friday of the month, but since this next weekend is the 4th of July, it will come out on Thursday. It says this report is based on the current population survey of households and the current employment statistics. It says these reports are very important because Wall Street uses these to confirm estimates and drive decision making. So who uses these reports? Historically, the currency and bond markets have been most impacted by the employment situation summary, but really the economy as a whole is affected. It says here that a large increase in employment could cause the dollar to strengthen, but that the currency market has become increasingly sensitive to the data. It says here that a strong employment report could potentially indicate that the economy is heating up too quickly, which would lead economists and traders to be concerned about inflammatory pressure. It could also raise concerns about tighter monetary policy and increasing interest rates. But overall, the equity market looks at rising employment as a good sign of corporate strength and optimism. It says here that these employment numbers are not without flaws. Recessions and layoffs can drive people to go into business for themselves, such as skilled laborers that become consultants, and they often consult for their former employers. These numbers can be unaccounted for in the survey, which would cause the number of unemployed to be exaggerated. Conversely, when the economy begins to accelerate, some self-employed people may decide to go back on payrolls, which would even further reduce the unemployment rates. To summarize, regardless of the flaws in the data, these numbers are widely regarded by economic analysts, and they use these numbers to make decisions on the current financials and the strength of the economy. And as a trader, I find it important to keep track of these things and when they come out, because they tend to increase volatility. So overall this week, I am currently bearish. So I'm going to continue to trickle money into stocks. I think once I see the market drop a little bit more, I will start to increase the rate that I invest. I do think we'll see a higher low, maybe somewhere in the vicinity of 280, maybe a little lower than 280. The bottom of the market in March was right around 223 for SPY. I don't think we'll go quite that low, but I think we might get close to that area. And if we do, I will be buying. Let me know in the comments below if you agree with my short-term bearish outlook, or if you're bullish, or if you're just going to continue to buy because you're a long-term investor. Definitely like and subscribe if you got any value out of this video. Of course, this is all for entertainment purposes. This is not financial advice. And with that, let's get to today's jelly. Today's jelly is Jerry McCulloch. He's a sponsored shooter, and he is attempting to shoot 5 rounds as soon as the alarm goes off. So that includes his reaction time, all under 1 second. If you've seen any of his stuff before, you would know he's very talented and well practiced. So let's see if he makes it.
And let's see if we can react and shoot 5. 5 on target in a second. Target in the middle. Here we go. I got a little bit excited. I actually fired 6 rounds. Let's go ahead and count back. I'm a revolver shooter by trade, so I work in numbers of 6 at a time. So that was 5 rounds and a 108. Not quite what I was shooting for, but not a bad warm-up run. One of the things good about this timer, I can go back and look at my performance. So what I'm looking at is my first shot was a .55. That's a little bit sluggish, but the actual split times in between shots was really good. So we had a 14, a 12, a 13, a 14, and a 10. So all I need to do to make this time happen is to really get off that timer and jump in the center of mass a little bit quicker. A 55 is kind of slow at this range, so I'm going to listen really good for that timer, get in the center and punch out 5. See if we can make it under a second. Here we go. Now that was a little bit better. You saw how I was punching out right on the timer there? Let's take a look at it. A .96. Made it that time pretty easy, so.
Clearly this dude is very, very skilled, and he has spent years and years on the range getting better at shooting. The dude shoots faster than anybody I've ever seen. I guess that's probably why he's the best. Let me know in the comments below what you think of his shooting. Definitely like and subscribe so you don't miss any of my future videos, and have a great day.